6%, I would call it, is a reasonable estimate or guesstimate of the average rate of interest. And we're much below that now. And we perhaps have embarked on a long-term bear market in bonds, in which case interest rates will gradually but persistently rise.
Financial thought leader Jim Grant is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We are delighted to welcome back one of Wealth Track's earliest guests who has graced our program over the years with his perspective on all things financial, which he is well equipped to do. He is James Grant, financial thought leader, historian, founder and editor of Grant's Interest Rate Observer, a twice-monthly journal he launched in 1983, more than 40 years ago. As you will discover, he and it are going strong. Grant is also the author of 10 books on finance and financial history, including The Forgotten Depression, 1921, The Crash That Cured Itself, which won the Hayek Prize from the Manhattan Institute. He has also written 3 political biographies, one of my favorites being John Adams' Party of One, about the remarkable life of America's second president. And his latest, Friends Until the End, Edmund Burke and Charles Fox in the Age of Revolution, which I am looking forward to reading. Grant is also a contributor to several publications, including the Wall Street Journal and Financial Times. But today, he is with us to discuss a number of topics. I decided to start with gold, an asset he has owned for years, not always to his financial advantage, but that is not the case today. Gold has been a stellar performer. I asked him why.
The world has come to reappraise the nature of money a little bit, I think. And some of that reappraisal has to do with comparing the nature and value of paper currencies, including the almighty dollar, with that of the ancient monetary relic, gold bullion. And central banks especially are coming to favor the latter over the former, which is odd and ironic because the gold price is kind of the reciprocal of the world's confidence in the people who manage our currencies. The higher the confidence, the lower the gold price. The lower the confidence, the higher the gold price. That is a general rule of thumb. As we speak, the trend has, just as you say, has been up for a while, for a long time. And I think it speaks to a general reconsideration or reappraisal of the nature and the efficacy of the world's monetary arrangements.
Jim, this is right up your alley. I mean, this is something you have been writing about for 40 plus years at least. And I'm wondering about what your assessment as to why central banks especially are buying gold, rejecting their children paper money. What's happened that there is this reappraisal now and that they're actually acting on it?
It's a bit ironic, isn't it? It's the kind of the consummate insider buying. I think people are looking a little bit at the seeming arbitrariness of American actions with respect to using the dollar as a geopolitical weapon. You know, saying no, you may not use Fed wire or chips or fast and dollar transmission mechanisms because we don't agree with your politics, or we don't like your invading this country or that country. America has been known to wield the dollar as a tool of negotiation or of raw power. I think countries like to have a little bit of agency. And for that reason, they like at the margin, they're liking gold. Gold is moving up a little bit in the league tables of world reserve assets. It has surpassed, we are told, the euro. It's gaining on the dollar itself, which would be that most interesting development.
So gold as a share of foreign exchange reserves are 20% plus. The euro was 16% the last time I looked. Yeah, and you're saying that we're underestimating?
A lot of these reserve figures are are educated guesses. For example, people must speculate with respect to, for example, the Chinese official holdings of gold bullion. The Chinese by no means acknowledge everything they have.
Jim, you are a financial historian. The recent, again, reappraisal of gold, and I'm assuming the reappraisal of the dollar as a result, coinciding with, or the reason that gold is becoming more popular. Has it been more marked recently?
Gold has been coming back in the past year or so with surprising power and lift, because why? What makes gold go up? Well, historically, Consuelo, the owner of the strongest currency, a reserve currency, was one with the strongest and biggest navy. And the United States no longer has title to that distinction in the Pacific. China, yeah,
has the largest.
So there
navy.
might be some at the back of the minds of some of the buyers of gold, say in Asia. Asia's been the center of this buying. Maybe there's some recalibration of geopolitical strength. Again, one doesn't know. Actually, there's been very little, relatively speaking, very little buying here in America, and not so much in Europe. Although Europe is a big legacy holder of gold. France and Italy, and Germany especially, hold a lot of gold. And by the way, some of them, these countries want to repatriate it, as if to say, America, you've been so nice to keep it for us, but we watch the news too, and we think we'd rather have it here.
Right, it could be confiscated or frozen, or so they're actually repatriating. I don't know. Has Fort Knox been holding gold for the
Fort Knox and some at West Point, I guess, and some at the Federal Reserve Bank of New York.
For governments, for foreign governments, European governments, for instance?
In the 70s, France, and 60s, France would send a French capital ship, a battleship, or a cruiser. So the French would send an imposing ship and bring back some gold and store it in their own vaults. So some of that's going on too. So all this is, again, it's the reconsideration of what's money, what's dependable in money, what will hold its value as money. And into that reconsideration figures such things as geopolitical power and financial power and the dependability, especially, of the central bank. Now, when Donald Trump says he wants a central bank chairman who will know his phone number and call it. I'm freelancing somewhat in this, but and call me when you have a decision to make, and we'll make it together. You know, and please know we want low interest rates.
Right. So, I mean, number one, that has happened many times where the Fed chairman was basically beholden to the president.
Yes, yeah.
And over the years, you have been a critic of the Fed, of the central bank, and the kind of the power that it's amassed in attempting to do all sorts of things with the economy and the currency. But how do you feel about the fact that Jay Powell is being lobbied hard by the president and, you know, possibly might be replaced early?
Oh,
I mean, how do you feel about the Fed's independence? And
those are wonderful questions. And by way of preface and background, the Fed originated with the Secretary of the Treasury having an ex officio seat on the Board of Governors of the Fed. Mm-hmm. So from the beginning, the administration had a voice in monetary policy. That ended in 1935. And along the way, presidents have leaned heavily on Fed chairmen. Harry Truman did it. Lyndon Johnson did it. Richard Nixon did it. But few have done it openly, so vocally, and so crudely as President Trump. As to Jay Powell, I am beginning to like him.
I was going to say, do you actually now have some sympathy for Jay Powell and respect for him standing up?
I respect his dignity, and I respect his forbearance in the face of these provocations.
Jim, we can laugh about this, but this is serious stuff. At stake is the privilege, I think you call it, of having the reserve currency. I mean, at stake is the U.S., which is basically the kind of the financial banker of the world. At stake as well is what is considered to be the risk-free asset, the go-to safe haven, which is U.S. Treasuries. Talk to us about what is happening, that whole concept of us as being the risk-free asset and also the reserve currency.
Well, risk-free has always been a misnomer, hasn't it? I mean, the capital losses borne by the holders of longer-dated securities of the United States government, intermittently over the past 50-some years, has been enormous. There was 40 years, of course, of great bull market, great gains, but your portfolio was shredded by the run-up in interest rates up until 1980. And the Fed itself is testament, its balance sheet is testament, what can happen to holding low-coupon mortgages and government securities as interest rates rise. The Fed is solvent by courtesy. The mark-to-market basis, indeed an operating basis, compared to its meager capital, the Fed would be insolvent except for the Treasury's open checkbook. So that's one consideration. So the Treasury securities have never been risk-free. However, they have functioned in a way as the backbone or the marker of the North Star, perhaps, of professional finance. And people say,
right.
They call it shorthand a risk-free thing, which they should not, but they do. America has lived off of the institution of the world's reserve currency to our great benefit, but also to our detriment for many years. Now, what do I mean by benefit? Well, because we can and do consume much more than we produce at home. We finance the difference with securities the world has wanted. Detriment. That's because we have relinquished a great deal of our manufacturing prowess. And indeed, this relinquishing is what, in a way, has powered the movement that has brought Donald Trump to the White House. It's a little bit of a poison chalice, because what you don't want, it seems to be in life, is to be the feckless heir to a very large fortune. Here, my son, here's $15 million. Go out and drink yourself to death. That's not a good way to go. So the reserve currency privilege I take to be a bit of a poison chalice, and I wouldn't mind at all seeing America having to work harder to export more and import less, but that's a personal preference, and the world actually has that preference in its own hands. So this arbitrage, so to speak, between wages on the one hand and demand and desires on the other, it explains why we have such a big net international debt. They call it a negative financial position. We owe much more to the world than the world owes to us with respect to financial assets.
Yes.
And that's fine until such time, indeed, there will be such time, as the world decides it would rather own fewer dollars, or it would like interest rates to rise on the securities that they are meant to buy. So it's not as if the world is going to say, we don't want Treasury bonds, period. They will say, we don't want Treasury bonds at this price. You know, Wall Street saying, there are no bad bonds, only bad prices. But note also that the interest on the existing outstanding body of Treasury securities is the fastest growing program, if it were a program, in the federal portfolio. Faster than anything that HUD does or the Defense Department is doing, or
the entitlement programs.
Yeah,
the third rail programs.
It's the fastest growing, faster growing than Amtrak. It's immense and getting immenser, if that's a word.
That's significant. That's a marker. That's something to note.
Well, also it's observed that these are not very high interest rates as we have historically measured rates. I think kind of the average interest rate from Alexander Hamilton to date is called 5.5% or 6%. That's in a high-grade security or Treasury bond.
Is that a 10-year? I mean, would that be the 10-year Treasury?
Yeah,
note or,
about. We haven't
Okay.
always had 10-year treasuries. We had railroad securities at one point. We had municipal securities of states and cities, but railroads, of course, big issuers of debt. But over the long course of our history, 6%, I would call it, is a reasonable estimate or guesstimate of the average rate of interest. We're much below that now. And we perhaps have embarked on a long-term bear market in bonds, in which case interest rates will gradually but persistently rise.
Grant's interest rate observer, obviously you follow interest rates, you follow a lot of things, but also inflation is very much part and parcel of this whole picture. What about inflation? I mean, people are talking about stagflation now. They're talking about the tariffs are a tax, and therefore, they are going to be inflationary. War can be inflationary. What's your inflation outlook? What are you telling your readers?
Yes, I believe we are stuck with inflation as an underlying trend. And I have thought this for a long time, even when there was no inflation to speak of much. Mm-hmm. And I think so because there's no discipline in fiscal policy making, and there is not that much in monetary policy making. Let us not forget the Fed seeks inflation. It seeks 2% a year and believes I say in its conceit or innocence that it can actually calibrate that, which I'm quite sure it cannot. But the current administration, the Trump administration, is all in for everything all at once. For example, Bill Pulte, the new head of the Housing Finance Department of the government, overseer of Fannie Mae and Freddie Mac, issued a tweeted release, a ukase, a declaration that, or pronouncement that the Fannie and Freddie should henceforth prepare to accept cryptocurrencies as collateral for a loan to buy a house. Whew,
wow,
that's a new thing. So whether it's Trump demanding that the Fed reduce its funds rate to 2% and announcing he will seek the Fed chairman that will do such a thing and will do it, he'll announce it early so as to cut the ground of authority underneath Jay Powell's feet. That's another thing. And the Republican Party basically walking away from its responsibility to implement a budget that is not going to prolong our long-term fiscal difficulties. All these things play into my view that we live in an age of too muchness, which is the essential element of inflation. It's an overstraining of things. And all this is without reference, for example, to the thing that unfailingly causes inflation. And that thing is not the money supply, it's war. War is what causes inflation without fail, the ages. So we're in the clear as long as Chairman Xi decides not to invade Taiwan tomorrow, or as long as Vladimir Putin is satisfied with what he's got in Ukraine. Doesn't go. So the world to me is I'm a yes but guy in a gee whiz world. I always think of the downside. I hope many of us consider the downside, but it's my first thought rather than my second thought. I think that between the administration's proclivity for overstraining of financial things on the one hand, and the world's susceptibility to violence and to organized war on the other, we are at risk of more inflation rather than less.
As far as the bond market is concerned, if interest rates are an upward trend, then what does that mean for bondholders?
Inflation is bad for bonds. It is probably the principal determinant of the long-term rate of interest, rate of inflation. It's not all bleak for bonds. One of the things that people don't often recall about bond bear markets is that you get to reinvest your coupon income at rising rates of interest rather than falling ones. And that can enhance the total return of a bond and mitigate the damage that done on a mark-to-market basis because of falling bond prices. Mm-hmm. And as to inflation, a point I think that one should not forget, the people in the bond market, indeed people on Wall Street, tend to look at the rate of rise in the CPI or the PCE or whatever their favorite measurement is, but they forget about the cumulative inflation that we have left behind. So inflation always ratchets up, right? So there's never any pullback in prices to speak of certainly not an average. So the reason that inflation is still a hot button item, even as the rate of inflation has moderated, is that people are still living with higher prices.
Right.
It drives them crazy. I think especially drives them crazy when they hear politicians and some apologists on Wall Street for this or that investment strategy. Well, there's some more inflation. On the South Lawn of the White House, Trump was saying there's no inflation. There is, by the way. But what I think people think of when they think of inflation is what it costs to go shopping, not what the rate of inflation how it's changed in the past month so much as the fact that it used to be this much.
Yes.
And now it's that much. And what the heck is going on? I think that is the calculus of many voters and shoppers. And it's what's wrong with the paper money. One of the things that's wrong with the paper money system, in the bad old days, they called them the gold standard, there would be alternating periods of inflation and deflation. Not all of it unwholesome, because sometimes wages rose faster than prices fell, leading to higher real wages. That was good. But in a time of perennial inflation, and this is a time of perennial inflation, no matter how small, prices only go up, and real wages can't always keep up, and there is the accumulation of inflation come those moments such as 2021 and 20 and 21 and 22 and 23, in which inflation just races ahead, and you never get that purchasing power back. William McChesney Martin, the great Fed chairman of yesteryear, said, "You never reclaim the purchasing power you have lost to inflation."
Jim, one investment for a long-term diversified portfolio with the background, the environment that you've just portrayed for us?
For me, it's been gold. I've held it for as long as I've been of age to hold it.
For better or for worse is basically been your relationship with gold. It is
both.
now better.
For better, but I tell you, it can break your heart. Just when you think you have every reason in the world to double tomorrow, it doesn't, because so the gold satisfies that portion of a portfolio that's meant to insure against the fragility of the human condition and of human judgment. So it captures war, it captures errors of all kinds and fragilities of all kinds, the fragile judgment of central banks. That's what gold does. It is something steadfast that it does the work of solid money. And it's not going to get taken over. It's not going to reinvent the wheel. I'm not saying it's going to go up tomorrow. In fact, it has gone down a lot as we speak.
And you think that we are in a prolonged bull market in gold?
Yes, I think we're in a prolonged bear market in the institution of paper currencies and of banking, prudence in banking. Therefore, reciprocally, in a prolonged bull market in the price of that asset, which does service as an antidote to the shortcomings of bad banking and bad central banking.
Jim Grant, thank you so much for joining us on WealthTrack.
Oh, Consuelo, it was such a pleasure. Yeah, nice to be with you as always.
Ever since WealthTrack's launch 20 years ago, we have given you one suggestion to help you build and protect your wealth over the long term. This week, we are tapping the wisdom of our guest, James Grant, and asking him to share the best piece of investment advice he has ever received. So this week's action point is never stand in line.
Well, it's one I observed, and it happened in January of 1980, when gold was making a high that would stand as the record high for so many years after January of 1980. There was a long queue of people just as credulous as I, standing there in the freezing cold outside of the offices of Nicholas Deek, a corn dealer in Lower Manhattan, to buy a Krugerrand at $800 and something an ounce. But inflation was then peaking, or was about to peak. Paul Volcker was about to solve the inflation problem for almost a generation. And gold was going to go to sleep for almost a generation. And so what I learned from that was never queue up to buy anything. So The cue doesn't have to be physical, but beware of crowds. Beware of what everyone knows. Beware of FOMO, all the things that lead perfectly logical and well-ordered minds to commit the most heinous offenses against the basic sound practices of investing. You know, why do we always buy at the top and sell at the bottom? Well, you know, we stand in line. You know, but that's what I've learned, Consuelo, is never stand in line.
Excellent investment advice from Jim Grant, a lesson learned by many of us, including Jim, through trial and error. Next week, why Causeway Capital's award-winning portfolio manager Sarah Ketterer never stands in line. As a value investor, she's finding the most compelling values overseas following more than a decade of U.S. outperformance. Please follow us on Facebook, X, and our YouTube channel. Thank you for joining us as the U.S. celebrates its 249th year of independence. Have a sparkling weekend and make the week ahead a healthy, profitable, and productive one.